Aveng is not going to benefit from any proposed infrastructure spending in South Africa. They just aren't. If you think they will, you're wrong. But stick around to find out why. How's it going, guys? My name is JSE and welcome back to MoneyMetEish. Today we are going to try and answer one of the biggest investing questions of 2021. Is Aveng a good investment? To answer this question, we are going to take a look at the company, but this video is going to be a little different from our previous deep dives we've done, and more of my general feelings about Aveng. We'll have a look at what some people see as a bull case, we'll have a look at what some people see as a bear case, we'll have a look at their latest set of results, and then I will give you my final thoughts on the company, and we can see if I have been justified in mocking the stock in previous videos. But before we get started, please remember that my videos are meant for edutainment purposes only and should not be used as the basis for any investment decisions, as I am not a financial advisor, this is not financial advice, and this is not a blank cup. Today's video is brought to you by Tenacity Leather Studio. Based in Bella Bella, this father-son team create bespoke, quality goods at affordable prices from premium quality, full-grain leather, sourced from one of South Africa's oldest tanneries. Not only is each product meticulously designed for functionality and style, but each one passes through their hands in the making process. To check out their exquisite line of quality leather products, contact Tenacity Leather Studios on Instagram or on Facebook, links down in the description below. Tenacity Leather Studio. We're confident when we say our goods are made to gather a lifetime of memories. We at MoneyMetEish would like to thank Tenacity Leather Studios for their support and sponsorship of our video. Also, remember to hit the like button, subscribe and comment down below, and share this video far and wide. Also, ring the bell to be notified every time we upload new content. This video is going to be a little different from some of our deep dives we've done in the past because we will not be using the 5 key indicators when we look at Aveng, because I can tell you right from the beginning that there's just no point. The company has changed so much over the past 5 years that looking at 5 years of financial information doesn't really make much sense to me, to be honest. It's not going to mean anything. So instead, we will have a look at some of the major ideas around the company, and I will tell you if I agree with them or not. So let's start with what Aveng actually is and isn't. Aveng is not a South African construction company, the same way that Caterpillar is not a consumer electronics or a clothing company. In fact, the percentage of Aveng's revenue that comes from South African construction is similar in proportion to the cell phone production and ugly shoes section of Cat's business, roughly 2%. Aveng is a construction, engineering, and mining group of companies currently domiciled in South Africa and split into 2 parts, the core operating and non-core operating groups. The core operating group is made up of 2 companies, and the non-core operating group is made up of multiple companies, all of which are for sale, and none of which are going to be taken into consideration by us in this video, as the board has restated their commitment to selling off these businesses within the next 12 months. So instead of being the global construction, engineering, mining, and manufacturing juggernaut it once was, Aveng is really just an Australasian construction and engineering company and a South African contract miner. The non-core segment makes up less than 20% of group revenue combined, which is actually not negligible, but they're also all up for sale, so it's not worth looking at them when we're thinking what the company is going to be doing going forward, since they won't be part of the company going forward. This is why I said in the beginning that Aveng will not benefit from any proposed infrastructure spending done by the South African government. Australia, New Zealand, Thailand, Singapore, sure. South Africa, not a chance. A, They simply don't have the capacity to compete with the likes of WBHO or Raubex in the South African space for the type of work that would make any kind of impact, and B, they are not planning to keep any part of the business which would be involved. Again, the board has stated in its latest financial reports that it would rather sell them off than try and make them work. Now let's look at some areas that might actually impact Aveng. To do that, we need to look a little deeper at each of the companies that makes up the core operating group. And they are McConnell Dowell and Moolmans. Unlike Aveng's South African construction segment, McConnell Dowell is a major player in its markets as a multifaceted construction and engineering company which operates in Australia, New Zealand, the Pacific Islands, and Southeast Asia. The company is the driving force behind the Aveng turnaround plan and saw revenue growth of 50% last year. McConnell Dowell specializes in rail, hydropower dams, tunneling, and marine construction, and they currently have multiple projects underway in various markets across the various regions and in multiple areas it claims expertise in. Year-on-year profit in Australia more than doubled, and Southeast Asia grew by 24%. McConnell Dowell currently makes up 2/3 of Aveng Group revenue and 79% of the work in hand for the entire group, with 1.9 billion Australian dollars or 18 billion rands worth of work in hand and a tender pipeline of an estimated 8.8 billion Australian dollars or 94 billion rand for financial year 2022. These numbers are massive and I might be slightly impressed, but for the fact that the profit margins on this segment of the business is 1.8% and they have a profitability rate of 90% for their projects. So an estimated best case scenario for McConnell Dowell, assuming they get all the tenders, is a profit of roughly 1.5 billion rand or about 1/10 of an SAA bailout, assuming perfect conditions and no inflation on material prices. Now, the construction industry does operate with low profit margins, but even so, Aveng has one of the lowest profit margins of any of its competitors in the same space. Aveng is not going to benefit from South African government infrastructure spending, but McConnell Dowell is very likely to benefit in the regions it operates in. The other side of the business, which currently makes up 16% of revenue and 21% of work in hand, is the contract mining company Moolmans. Moolmans is a contract miner which offers open cut mining, shaft sinking, and underground mining services to assist in the extraction of various commodities, such as gold, platinum, coal, copper, and manganese. Some bulls like to call it a continental or intercontinental mining company, but I believe you can't claim to be continental or indeed intercontinental when you have 11 open contracts and 10 of them are in the same country. In fact, the only mine currently under contract with Moolmans that's not in South Africa is the Lifa gold mine in Guinea, and they haven't done work outside of the African continent since 2016 when they ceased operations in Chile. They did once have a much wider footprint across the African continent, having completed projects in 10 African countries. However, that footprint is also not what it once was. Now, Moolmans operates at a much higher margin than McConnell Dowell does, at roughly 6%, which is obviously much more pleasing than 1.8%. They have just been awarded 2.8 billion rands worth of contracts for 2 existing mines that they operate. One, Klipspruit, which is a coal mine, and the other one, Gamsberg, which extracts zinc. But, and this is a big but, and something I haven't heard any other commentators speak about, bulls or bears for that matter, when discussing Aveng, is just how much Moolmans would have benefited from the commodity boom we have experienced over the past 12 or so months, and it'll be interesting to see how they perform now that the prices of iron ore and platinum, which together account for 60% of the mines they operate, are down 28 and 26% respectively over the last 6 months. So now that we have looked at the companies that actually matter, and we have looked at what Aveng is, I would say that the scaling back of the company, although massive, is a good thing. Rather have a smaller business and focus on the parts of the business which actually bring in some sort of revenue and value than have a loss-making behemoth. So let's have a look at some of those finances now. Aveng is profitable for the first time since 2014, and it's got the bulls in a frenzy. The fact that Aveng has a massive amount of 500 million rand added to their balance sheet from the sale of an asset which actually isn't sold yet has been seemingly and conveniently ignored by all Aveng bulls except Ryk de Klerk, who wrote a great summary of the latest financials for IOL, linked down below. One thing nobody, bulls or bears, fails to mention is the massive amount of debt Aveng has. Aveng has a total liabilities of 8.9 billion rand, with 10% of that amount, 890 million, having to be paid back in exactly 2 years' time, as they recently restructured their debt, committing to pay it off by September 2023. They were able to pay down a massive 1 billion rand of interest-bearing lending in the past year. So in terms of paying off the debt, the actual sales of the remaining non-core segments should help Aveng meet these debt obligations if all goes according to plan. Although, I doubt they'll be able to have another rights issue anytime soon, and that did contribute about 80% of the money they used to pay down debt. So we'll have to see what happens. The board tasked with implementing this turnaround plan is relatively new to the company, but not the industry. The captain trying to steer Aveng through these rough seas, Sean Flanagan, has only been at the company for 2.5 years, but has over 30 years experience in the industry, having previously led Murray & Roberts for 19 years. But he isn't the only face on the board that hasn't been at the table for too long, and the board has an average tenure of only 4.5 years. Normally, this would be problematic, but I personally see this as a positive, because it is a completely fresh start in my eyes, and hopefully this board can steer the company away from some of the practices it seems to have normalized in the past, such as price fixing or collusion, which have cost the company billions in fines and legal fees over the past 15-odd years. Now, the reason Aveng is on so many people's radars is the price. At 5 or 6 cents a share, there is a strange romanticizing of buying shares for 100 rand and getting 1,500 shares, especially when you are a beginner investor and that same 100 rand would not buy you a single share in WBHO and just over half a share in a company like ShopRite. The current share price of 6 cents is down 99% from its all-time highs, and even post-share consolidation, which we'll look at in a little bit, I don't see the company being able to reach anywhere near the heights it did in the build-up to the 2010 World Cup. In the past year, it would seem that the board has really made very good use of stock splits, raising not one but 2 tranches of rights shares and raising 865 million rand from the issuance of shares for financial year 2021, all of which went to paying debt. Actually, 870 million rand went towards repayment of external borrowing, so they were actually still 5 million rand short, but having raised massive amounts of money has given them some room to breathe a little easier. But it is also a massive amount of money that the company received, which is not part of its core operations, so cannot be relied upon or taken into consideration for the future. And if you take out the income from the rights issue and the sale or non-sale of non-core assets, the financials look very, very different. The shares in issue went from 19 billion to 64.7 billion shares. And it's no wonder that the company decided to pursue a share consolidation before the end of 2021, with Aveng Financial Director Adrian McCartney confirming on MoneyWeb that the consolidation is necessary to reduce admin costs, reduce volatility, recalibrate the supply and demand for the share, and improve liquidity. He used an example ratio for the consolidation of 100 to 1. But did stress that the ratio is likely to be much higher. So what does the share consolidation mean for retail investors? Really, not much. If you own 1,000 rands worth of Aveng shares, totaling roughly 16,666 shares, bought at 6 cents each before the consolidation, you will still own 1,000 rands worth of Aveng shares, but instead of holding 16,000 shares, you'll hold 166 shares priced at 6 rand. The value of your shares didn't change as a direct response to the consolidation. They may change based on the market's response though, since there is now more room for the share to find a fairer share price and a more manageable price movement than jumping 30% every time the share moves 1 cent. For those who are lighting candles for Aveng to reach 1 rand, this is the only way it is ever going to happen, despite Simply Wall Street's estimated fair value for Aveng of 1 rand and 4 cents, which would suggest that Aveng is currently 94% undervalued. Simply Wall Street only have one analyst following the company at the best of times, so take their forecasting with a pinch of salt, especially since they state in almost every forward-looking segment they have on their website that they have insufficient information to make a forecast. So for some people, who I won't name, to be using this number or even the previous estimate of 63 cents as gospel for the fair value of Aveng is dangerous, as it suggests to new investors that this company is going to go from being 6 cents to 1 rand while still being able to maintain 64 billion shares. If that were the case, Aveng's market cap would go from 3.7 billion to 65 billion. 16 times what it is now, or an increase of 1,600%. The final bull case we are going to have a look at is the institutional interest in the stock. The majority of Aveng is owned by big institutions, and JP Morgan is often spoken about. But the division of JP Morgan, although it has JP Morgan in its name, is actually JP Morgan Securities PLC UK, a small subdivision of a subsidiary of the UK division of JP Morgan, which itself is a subsidiary of JP Morgan Investments International, a subsidiary of JP Morgan Chase & Co. So suggesting the interest is somehow tied to the US banking giant is like suggesting an investment made by Africa Magic is somehow directly attributable to Naspers. But maybe that's just me being nitpicky, and even so, they only own 2% of Aveng A-class shares and 4% of the ordinary shares. Institutional interest is generally seen as being a good thing in a company, but I don't see this as the case for Aveng. Institutions and hedge funds own 85% of the company, with almost half of that ownership stake being held by just 2 companies. I see this as a risk on 2 fronts. One, if they decide to sell a large part of their holding, it could cause a major movement which could tank the stock. And 2, it poses a risk to retail investors, who own just 6% of Aveng, of the company being taken private, and there indeed are whispers of either a dual listing, delisting, or an unbundling of McConnell Dowell in the future. Although these are all just whispers, but all of this to say that just because an institution is interested doesn't necessarily make it a good thing. Institutions also make bad investments. And hedge funds are not passive investors. They tend to take a very active interest in their holdings, which also makes me wonder just how much influence they have over the board and the decisions they make. My final thoughts on Aveng are that there is still a lot of the story yet to unfold, and we will personally not be touching this stock right now. There are people with a much higher risk appetite than ours who are happy to take a punt on Aveng, and if that's what you're doing, cool. But this stock doesn't fall into any of the categories we look at for an investment at MoneyMetEish in its current state. It is enjoyable and interesting to watch from the sidelines though, so we're getting all that entertainment value out of it. I would rather wait to see what happens after the share consolidation before I even look at the stock again in any sort of meaningful way. When even the bulls are having to give disclaimers that they are only putting in amounts of money that they are willing to lose to take a punt, it shows me that even the bulls are struggling for conviction in the future of the company. We are not personally invested in Aveng, and in the end, it is up to you to decide if you want to invest or not. As this is not financial advice, I am not a financial advisor, and this is Tenacity Leather Studios. Link in the description below. Thanks for watching, guys. Please give the video a like, comment and subscribe down below, and ring the bell to be notified every time we upload new videos. You can also follow MoneyMetEish on Instagram and Facebook and everywhere where MoneyMetEishes are. Thanks and good night.